Hello. In today's video, I'm going to try to answer some of the most common questions I'm asked. Let's start with a question that really could be two different questions. How and when do I decide to either stop trading a coin or change its recipe? There is no real direct answer to that except when I feel the market is taking longer than I want to risk for a given profit ratio. Here I have one coin on 3 different charts with 3 different recipes. For example, a 30-second recipe with the average profit here of 2.2%. This one is a 1-minute recipe with an average profit of 2.7%. And finally, a 13-minute recipe with an average profit of 3.5%. All the same coin. All capable of dealing with the market very aggressively and acutely with different levels of risk. But the one thing they all share in common is they only allow 9 maximum positions. That's it. $99 is all I'm willing to risk for this coin, no matter which recipe I choose. So basically you're looking at 1.7 days for a 30-second time frame, 3.5 days for a 1-minute time frame, or about a month and a half in that range for a 13-minute time frame. And as you can see, the 13-minute does have exit positions, so I've hit my 9 position mark and got out. Carrying a 3.5% profit ratio for this particular recipe is good, but it still means a month and a half to acquire my percentages. It has a higher exposure rate to the market than a 1-minute one at 2.7%. And finally, the 30-second one has the least amount of exposure and the least amount of trades. But am I doing better or worse by picking this recipe over this recipe? There's no way to easily answer that because there's no way to predict the market. For example, this recipe, you can see right off the bat, I do have my exit position. It is hit. So I take a loss. That's calculated. Here is a second loss calculated. A third loss calculated. A fourth loss calculated. 5th, 6th, 7th, 8 losses and still going. 9, 10, 11, 12, 13, 14, 15 losses. So in this roughly, going all the way back to March, 15 deliberate losses. And yet it still pulls off a 3.5% average. That is impressive. But I prefer not losing at all if possible. This is probably the most responsive to the market. As you can see, it really gets in and out appropriately. But right now, for my risk assessment, I don't want to hold as long as this does. So this recipe is a little more aggressive. It's at the 1 minute. And as you can see, it does pretty well picking and filtering the PSaR, or parabolic stop and reverse. So here we have just a parabolic stop and reverse connected to the DCA. Here we have parabolic stop and reverse connected to Rule 37 and then to the DCA. So we're filtering, and we're doing pretty good with that filter at a lower time rate, so less exposure. And finally, here I have a whole different approach, a MACD double confirmation. And this one is unique. I'm actually trading on the 30-second time frame, but the confirmation is using the 13-minute time frame. So I'm kind of in between both of these recipes. So if I was to rank this, this would be the first most aggressive, this would be in the middle, and this would be least aggressive, subjectively speaking. Although that's not always true, because this has less trades per time frame than this per time frame. Or does it? At a 30-second time frame, I have 8 trades. So at a 1 minute time frame, I would have 16 trades. So for every minute, this one pulls in 14 trades. This one has the potential to pull in 16 trades. So from the question of when do I change a recipe, it's when I feel the opportunity of a coin may provide me a better situation with minimal risk increase. In this case, I started out several weeks ago here, trading this coin with this recipe. The results area of the support server shows my profits doing very well from it. Then I switched to this recipe, which brought in my largest daily profit of roughly $20 for the FTX exchange. And over the last couple of days, I have been testing this recipe, and we will see if it does as well as this one. Now, the one thing that you will see in every single case, every recipe I have is making money. The question becomes, if every recipe is making money, what is the difference? All 3 recipes have a limit of $100. All 3 of them are profitable. Why not just pick the one with the biggest profit and call it a day? You can, and there's no reason not to. As many of Jackrabbit's subscribers have noticed, when I find a good recipe, I tend to move all my coins to that recipe over time. For better or for worse, I tend to let my trading work for me. I'm not necessarily able to watch all of my trading constantly every single day. So a recipe that takes 15 losses throughout its life is a higher risk, even if it has a higher profit ratio, than a recipe that may not take any losses at all, even at less percentage and slightly slower. So that is something that I weigh in the back of my head when I consider what recipes I want to use and when I'm going to change them. It is a problem that doesn't easily resolve itself. In this case, a lower recipe, but yet I have a much more significant profit basis per trade, which means less risk. Less risk also means less positions, less exposure. So if I can't get back to a trade easily, I'm not going to worry about it. But if I come into a trade and I see the price is here, I am likely to manually sell and simply take the profit. So this kind of a recipe gives me the option of an early out where I feel comfortable, just in case I may not be able to get back to it. And even if I don't, and I don't take an early out, I still make a profit. Now, obviously, this is a better profit than this is. But from the standpoint of my trading, which I spoke about in my last video, I treat my trading as a hobby. The money is lost as soon as it left the bank account. So anything that comes back is a blessing. So I don't see this as a loss versus this. I see it as a profit because it could have easily have gone the opposite way and my position can be underwater. Never chase profits. If you have a profit above your average, take it and be happy. Chasing profits only causes losses. And it also causes you not to appreciate the fact that you have money in the account when somebody else who complains about this position and selling is going to end up holding it and being stuck down here in a loss. Don't stress over your trading. When it happens, it happens. If you've done your research and you've carefully checked your coin and planned your budget, it doesn't matter if you sell here, here, or here, as all three of them are profits. All that matters if it sells below the blue line, then you're taking a loss. So as you trade, don't get caught in a game of having to sell up here unrealistically. Don't take this as a loss because of this. This is a profit, it's still money earned. This is a profit and still money earned, even though it's not as much as this. As long as your fees are paid, you're in the money, you're in the profit. That is something that cannot be underscored. Don't let yourself get caught in that trap. So as you can see in scrolling through these trades, not one single exit marker. So even though This recipe has a 3.5% average profit right now. It also has 15 forced exits. So far, this particular one here, this middle one, not one single exit. So even though it's not making as much, it's also not losing as much. And there we are, all the way back to the beginning of the chart. Not one single exit in this chart. Now, could it potentially take an exit? Yes, it could. And that is something indicative of the recipe itself. Is it likely to? That I don't know. But we can take a look at the statistics and get an idea. Okay, it never goes above 6 positions. So the likelihood of this hitting the exit point statistically is not as good as this that has hit the exit point 15 times. So that is good at a 14%, a 2% profit 14 times is very good. So now let's look at the most aggressive in time frame. 30 seconds. Maximum 4 positions so far. 8 trade cycles, 2% profit. This is good. It's less exposure. 4 positions versus 6 positions. It's a smaller time frame, so I'm going to make more trades for the same minute as this time frame. 2 more trades. Now, will I make as many as this time frame? Probably not. But realistically, this has the highest level of risk because of the direct and consecutive exit positions. Now, what would happen if I were to raise the exit positions? And it is always a possibility. After all, it's such a winner, why not double the exit positions? So let's go with 19 exit positions. Okay, now let's see the statistics. Okay, and as you can see, 19. This still hits the exit position. So it still takes a loss. Is the profit better? I don't know. Higher risk, there's definitely less trades. Personally, I say no. I say the lower the risk, the better the recipe, even with the 15 losses, versus the probably half as many as this 9 positions are going to cause. So realistically, I personally think this one is better, taking more losses. But this one is the one I'm testing right now. Only 4 positions. No losses in 1.7 days. So basically every 2 days, crudely speaking, I have roughly 16% profit for my original position size of $11. So while it's more aggressive profit-wise, it's not as aggressive exposure-wise. But it's important to remember, More exposure, more profit. 2% on $10 versus 2% on $100. That's 20 cents versus $2. Risk-reward balance. You can't get profit without risk. How much risk versus how much profit is the balancing act that you have to spend time evaluating, looking at, and determining appropriate to your own risk assessment. Now here, this got out early. All of this profit was left on the table. I personally don't care. Hindsight is 20/20. This whole market could have taken a giant nosedive. Profit in the bank is better than the potential profit that went down the drain because you didn't sell. Again, this emphasizes my point of not chasing the market. There's just no way of knowing or predicting which way the market could have gone. I could have purchased up here, expecting it to continue the trend, and look what it did. It took a dive. I cannot emphasize this enough. Don't chase profit. You see this all the time on Twitter. People criticizing others for taking a 2% profit, but when the term happens and these markets do this stunt, they're the ones crying over their losses. My profits are in the bank nice and safe. I'm happy. The table I have is clear. I don't stress or worry about having my profits. Whatever I have going on in my life is simply going on. This is going to do its thing for me. Because no matter what, I have a very limited exposure. Here, I got it right. I got out. It went up, then it nosedived. The people saying I should have held, well, look where they would be at. It did recover, but I would have taken more purchases to average into the profit. This is a one position perfect profit, something I can live with quite happily. And I'm not having to watch it constantly. So for a 30-second time frame recipe, it's doing very well, no stress on me, and yet it's simply ticking away with the market no matter what happens, slowly accumulating and building profit over time. Here is a good example. I purchased it here, the market dropped. Another purchase took place, it made its profit. The market could have easily dropped again and did a little bit here, and it dropped a little bit here before it reached here. But then it dropped again. I'm out here, I have 2% profit, I'm sitting nice. A lot of people mention the fear and greed indicator, and that being the decision process when they should get in and get out of the market. For my personal risk assessment, I don't get into that game. This is my metric. Pure, unadulterated analysis. Entry point, exit point. If it gets out down here or gets out up here, it doesn't matter. I've made my profit. I'm not worried about losing it if a giant market drop takes place. So, to answer the question specifically, when you change your recipe, you change your recipe when you feel you have a better opportunity after careful testing. I tested this strategy for 2 months. I tested this strategy for another 2 months. And I tested this one for 2 months. So altogether, all 3 strategies have 6 months of analysis. Even though I only have a couple of weeks actual trading here, about a week trading here on this coin, and most of my other coins still use this strategy. And here, roughly 2 days so far for trading this coin. So you change recipes on your coin when you start losing money, or you feel you have a better opportunity with less risk. Always remember, everything must be on a basis of risk versus reward. You could easily put $1,000 positions down on this and come out with $20 a shot, but at the same time, if you hit this severe market drop, every position is another 1,000. Is it worth the risk for the reward? For me, using an $11 position, 22 cents per position is perfectly fine for my risk-reward combination, especially if I'm not taking losses over time. So less losses means longer, better profits. I should say longer term, better profits. Even though my average is higher, that average still counts these losses. What would my average be without 15 losses? Here is 14 trades, trade cycles, 2.7% profit, no losses. That's good, and that's 13 times faster than this one. So even though this has done 198 trades in the period that it's been running, this one has the potential to achieve 13 times as many trades for the same duration. This one has the potential of doing double this one. So as I evaluate my coin choice, this coin is performing well with this particular recipe, well enough that I'm willing to take and try trading it with real money, knowing full well my maximum exposure is only $100. Will I come out in the end with more than this profit? Maybe, because this is crudely almost a 600% profit for basically 6 months, I think, 5 months. Now here for the duration, this is a 28% profit, and that is roughly 3.5 days. Now what will that be after 4 to 6 months? Well, it will be close to this one. And finally, this one, 16% profit, roughly speaking, for 1.5 days. So basically, 32% profit for the same level of 28% profit, roughly speaking. Better profits, lower exposure. That is a decision process for why I would want to change this recipe. But you can't talk about changing a recipe without first talking about the considerations of how much that recipe is going to bring you or how much exposure you're going to have, because those take into account the whole process as well. 1.7 days versus 3.5 days versus a month and a half. Different exposures, different risks. With this recipe, I'm going to be able to get out of the market quicker. As something goes wrong, on a 13-minute recipe, I can trade manually. Even at the 1-minute recipe, I still have the opportunity to put a manual take profit on my exchange. But when you get down to 30-second recipes, you're depending upon everything to work properly, perfectly, all the time. That doesn't happen. But limiting my exposure provides a buffer to ensure that I have less to worry about. So hopefully that covers when to change your recipe. When to change your coin. That is not as easy and often more difficult. Typically, I change my coins when I see a consistent drop in the profits and a consistent increase in the exposure. Then I know the market is turning against me and I need to find better opportunities. It's a combination of multiple factors that layer upon the first part we just discussed. Because sometimes the smallest changes can have the biggest impact, both positively and negatively. So as you trade, chasing coins or changing coins all the time is not the best approach, because you will always come into the market late. Your best approach is to pick a coin and stay with it until that coin proves that it is going against you. If you have a 1.7 day recipe, chances are you're going to want to wait 1 week. If you have a 3.5 day recipe, chances are you're going to wait 2 weeks. If you have a 13-minute recipe, chances are you're going to have to wait a month to collect the information you need to properly determine if the market is really changing against you or if it's just a dry spell. Markets fluctuate constantly, and it is important to understand those fluctuations. If you get jittery or shaky or nervous about your trading, your risks are too high. Your trading needs to be dull, boring, and in the event that you can't get back to your computer or tablet, or if something breaks in the middle of the night, you don't have to worry about losing large amounts. Risk mitigation is critical. Probably one of the most important things of trading that you have in your arsenal. Understanding your risks cannot be underscored enough. So, you pick your coins based upon metrics and market analysis for your finances and risk assessment. Don't change them until or if the market changes against you on a prolonged duration. Spend the time picking good coins to begin with. Don't chase coins, and don't trade coins that don't have basic fundamentals. When I look at a coin to trade, I have an absolute rule that I will not trade any coin under the value of 1 penny. That means a lot of good coins aren't traded, but they're not appropriate to my risk assessment. So for me, they're not good coins. You need to have these boundaries set clearly and concisely when you're setting up your trading. Before you ever make your first purchase, you need to know your risks, your budget, and how much you're willing to expose. All are critical points of coin choice, when to rotate recipes, and finally, when to rotate coins. Sometimes it's not a matter of rotating them, but simply not trading that one coin and not picking up another one. So, stay safe, trade safe. And as the old saying goes, you need to make your money work for you, not you working for your money. Using this type of an approach and an analysis, while no market is perfect, you are able to find a market and a recipe that fits your personal risks and your personal budgets. In all 3 cases, all 3 of these trade only $100. That's it. So for a $1,200 budget, I can comfortably trade 12 coins. If I want to be a little more defensive, I would only trade 11 coins. But I still have a clear, concise, and definitive approach. That approach is my trading journal. By being set in that approach, I can get away with not documenting everything because the recipe becomes part of the journal directly. And by having this kind of a thinking process, I can see where I'm doing if I need to pick something up later on without necessarily referring to my journal. I have all of these recipes stored, many of which go into the sandbox area within the Jackrabbit support server. And all of them make money. So the issue isn't not making money. The issue is management and risk. If you can manage your budget and manage your risks, you are reasonably going to profit, no matter what approach you use. There are a few certain exceptions, like a coin being delisted or a market apocalypse. But for the most part, the best approach you have will always make you money as long as you plan carefully. Money management and risk management are the keys to success in trading. The recipe just determines the rate by which you will profit and how much exposure you have at that moment. So whatever approach you choose, as long as you manage your money and manage your risks, you will profit with patience. Hopefully this answers questions regarding some of how I trade and provides a little insight in terms of when to pick and choose different approaches and coins. Be sure to like and subscribe if you're not, and let me know what you think in the comments below. Also, let me know what you think within the Jackrabbit support server. Until next time.